Okay, so we shall start. So good morning, good afternoon, or good evening, depending where you're located. Thank you for joining us. We are pleased to welcome you to this webinar, which is organized in collaboration with the Prince Accounting for Sustainability project, also known as A4S. My name is Brigitte Raffenjot. I'm lead on the network content at the IIRC. During this webinar, we will explore how businesses can adapt their existing capital investment appraisal processes to integrate social and environment issues with the A4S Essential Guide on Capex and a case study. This guide is one of a series of guides published by the A4S CFO Leadership Network to help organizations embed social and environmental consideration in their strategy, culture, and processes. In other words, this guide supports the adoption of integrated thinking and management. These guides are designed to inspire the financial community to action by providing practical guidance, knowledge, and case studies. However, they will also be of interest to others seeking to understand current approach for integrating stability into financial practices and decision-making. Each guide is supported by case study from the A4S CFO Leadership Network members, which demonstrate practical application of the approaches and techniques set out of the guide. Currently, there are 8 guides available, which you can find on the A4S website. Next slide, please. I will introduce this webinar and lead the Q&A session, which will take place during the last part of this webinar. To discuss about how to embed sustainability into capital investment appraisal, we have today the pleasure to have 2 speakers who will share with us their insights, their idea, and the lesson learned, and will exchange with you on this topic. Our first speaker is Ellen Slinger, Executive Director at A4S. Ellen will present an overview of the A4S practical guidance developed to assist companies to integrate sustainability into capital investment appraisal processes and decisions. Our second speaker, George Cobb, Group Sustainability Accountant at SSE. SSE is a UK-listed energy company with operation and investment across the UK and Ireland. George will present to you how SSE has embedded sustainability into its capital investment project appraisal. Next slide, please. The 2 presentations will be followed by a Q&A session. I would like to emphasize that it's an interactive discussion. On the right-hand side of your screen, you will find a box that you could use to ask a question or make a comment during the presentation. You can either share your comment or question with everyone or send it only to the organizer. We also encourage you to discuss with our speaker during the Q&A session. To be able to hear correctly our speaker, we are asking you please to put your computer or your phone on mute. The webinar is recorded. The recording will be made available on the website of the IIRC and of A4S. Without further ado, I shall give the floor to Ellen Slinger, Executive Director at A4S.
Thank you, Brigitte, and good morning, good afternoon, good evening to everyone who has dialed in. I'm Helen Slinger, as Brigitte said, and I'm Executive Director at Accounting for Sustainability, or A4S for short. At A4S, we work across the finance and accounting community, and we do that with the objective of making sustainable business as usual. I want to start by thanking Brigitte and the IIRC for giving us this opportunity to share our work on Capex with everyone on the webinar today. We hope that you find it useful. I have about 15 minutes or so to give you a flavour of the materials that we've developed in this area. And in that time, I hope to give you some tips and some pointers to help you in incorporating social and environmental factors into your Capex decision-making process. Now, Brigitte has mentioned the comments function. I want to try and use that from the outset, if I may. It's going to be useful for me to get a feel for the mix of people that are on the line. So if I could ask in very simple terms, if you're an accountant, a finance professional, or work within the finance team of your organisation, could you please type finance into that comments box? If you work in the area of sustainability or corporate responsibility, could I ask if you could just briefly type sustainability into the comments box? I can see those coming in now, great. And finally, if you have a different role to either of those, if you wouldn't mind typing the area in which you work. So I don't need your full job title, but risk, strategy, whatever it may be in the comments box. That would be incredibly helpful. So whilst those are coming in, I will make a start. Can we look at the next slide, please? So why did we develop this guide? As we know, capital expenditure, or Capex decisions, as I will refer to them, are generally ones with medium to long-term implications. It's normal for assets to have an expected useful economic life that would exceed 20, 30, or even 40 years. And given that typical lifespan, they often have a strategic role to play in the long-term viability and competitive position of companies. Clearly, for an acceptable return on investment to be achieved, they need to remain commercially viable regardless of changes in the operating context around them. As an example, we only really have to think of the recent political and media focus on climate change to get a sense of how the world around these capital assets is changing, and that it will continue to do so. Combine that with changing employee and societal expectations around the workplace, so in relation to health and well-being and things like acceptable working temperatures, adequate natural light, and how these factors are linked to productivity, and you quickly get a sense that there are other things to consider within Capex appraisals beyond the purely financial. Traditional financial appraisal techniques, which many of you will be familiar with, such as net present value, internal rate of return, or payback, are often therefore insufficient. And new ways are indeed needed to capture and analyse these greater information requirements to enable organisations to make effective Capex decisions. So given these new methods are needed, how does this fit in with what you do now? If you could give me the next slide, please. So to answer that question, let's look briefly at a typical capital appraisal process. Most companies already have a fairly sophisticated Capex appraisal process that consider a wide range of factors and work through a number of options to identify the optimum cost-benefit solution and to manage the associated risks. Sustainability considerations are simply another factor to consider within that, in terms of cost, in terms of benefit, and in terms of risk. So hopefully most of you can see the diagram on the screen. I'm just going to look at that and across from left to right as that process might typically run. So within a Capex process, many companies will likely have various stages and milestones to the process. These should look fairly familiar. So firstly, there'd typically be some sort of initial go or no-go decision to consider whether this asset is worth performing a more detailed appraisal on. Then where the decision is go, you would likely perform a more detailed analysis and assess what this tells you in a first stage approval step. If the asset still looks attractive, you may proceed to a more refined analysis to support your final decision making and conclude that with final authorization and delivery. And indeed, many organizations would also perform a post-investment review. So as you can see from the diagram, there are some key sustainability considerations in relation to each of these phases. At the outset, you should ask whether this asset supports your corporate strategy, your values, your targets and commitments, and if it reflects the key sustainable business considerations contained within it. You'd then think about how you can optimize value through asset design. So for example, can the building be designed with net zero carbon in mind, or what design features could you incorporate to enhance employee well-being? You should look to prioritize the most material sustainability factors. So those that have the greatest potential to influence the value of the investment and those that are of highest importance to the asset stakeholders. In the more detailed analysis stage, so that third stage, you should consider how this asset could be refined to maximize long-term value creation. So what's the optimum design combination for achieving the benefits identified in the previous stage? For example, the extent and positioning of solar panels, or how natural light or outdoor spaces can be incorporated. Selection between the different choices at this stage needs to consider both financial and non-financial factors, and you need to understand how each will influence each other. And at the review stage, looking back and considering whether you achieved your financial and sustainable business objectives, not just from a Capex perspective, but also from an OPEX and user experience perspective once it's operational. So next slide, please. Our guide looks at 4 key stages that you can follow when considering how to adapt your CapEx decision process, and supplements this with a number of case studies, which I'll come on to later. The first step is who to involve and what implications there may be for governance. The second step is what to assess. So, for example, what impact could the asset have during the material sourcing, the building, the operational phase and the end of life phases that may need to be mitigated. The third step is how to assess. So looking at different methods for accounting for sustainability in your CapEx process. And the fourth is how to decide. So how to set decision-making criteria and how to use the analysis you've carried out to inform a decision between investment options. So in the next few slides, we will look at each one of those in turn. Next slide, please. So as you might imagine, this is not something that the finance team should do in isolation, diligently filling in their spreadsheet in a darkened room. And I can't imagine that's how you do your CapEx appraisal processes now. You no doubt involve colleagues from across your operations team, from planning and from the business division that will benefit from the asset. You may use technical specialists depending on what the asset is. You'll likely also have an investment committee. It's the same when including sustainability factors. Use all this same expertise and get all input from all these stakeholders, but also incorporate your sustainability colleagues or other specialists and bring them into discussions at the start. Bringing them at the start is really important. I came across an example recently where the final build, the final asset was fantastic. It was based on collaborative space and on circular economy principles, but actually to get there, the journey hadn't been so smooth. And I think the building had already been designed and all the cost appraisal finally signed off before they went to the sustainability team and said, how can you make this a bit greener? And I guess there was quite a significant change made to the building at that point because they hadn't actually been in touch with sustainability colleagues earlier in the journey. So that start point is really important. And you should also consult with external stakeholders, those with a vested interest in the sustainability credentials of the asset. You could just click the next. Thank you very much. So when considering capital investments, we tend to think of sustainability from 2 perspectives. Firstly, the impact of CapEx decisions can be positive. So, for example, job creation, or negative, such as pollution or carbon emissions. Secondly, sustainability risks and opportunities may potentially impact on the success of the investment itself. For instance, returns can be improved if, say, a factory showcases sustainability innovation, which in turn leads to enhanced operational efficiency, brand image, and employee or customer loyalty. On the other hand, investment returns from the factory could be damaged if a carbon tax is introduced, or if water scarcity or flooding disrupts its operations or supply chains, or if there's something that impacts the well-being of employees in relation to the design of that building. Another example I've come across in my past is where employees in a building, because of the nature of the building, were required to work in very low or sometimes sub-zero temperatures, but actually there wasn't the ability for them to have access to a hot meal at lunchtime in their break in their shift. So actually having designed a canteen into that building might have been a good option at the start. And so thinking about these things sooner rather than later are always useful. So to help you with this stage, the guide provides a number of common sustainability considerations that are incorporated into CapEx appraisals. It provides several key questions that you could ask and lays out an approach that could be used to help identify different factors that may be relevant to the investment. Next slide, please. Thank you. So sustainability data isn't always as easy to incorporate. It isn't always as readily available and simple or robust as financial data. But it doesn't mean that it's not worth the effort to incorporate it. There are a number of different approaches that can be used in different situations, and this section of the guide we introduce 4 different categories of method and consider where each may be relevant to use. These are shown here with the top 2, the qualitative and quantitative being relatively straightforward, and the final two, stakeholder and shareholder value, being more complex and often involving things like monetization techniques. Content in this section is also supplemented by the appraisal techniques identified and discussed in our recent Capex Deep Dive publication, which I'll come on to in a few minutes. If you could just click the second half of that slide, please. The fourth and final area is how to decide. So the analysis of the previous section will help the decision maker differentiate between different options, but how do you take that differentiation to an actual selection? The approach you take here depends on the extent to which your analysis includes financial and non-financial data, the type of data you have, and arguably the level of ambition that you have towards achieving a sustainable asset. So this section looks at how you might go about setting decision-making criteria and how you would then apply them to the data you have. Again, the content in this section is supplemented by examples explored in our Capex Deep Dive. Next slide, please. The guide incorporates 10 top tips to help you as you refine your approach. So set targets. If you set targets, it's the same as with anything else, then you are much more likely to achieve improvement. Those targets will drive more innovative solutions and can facilitate engagement and action. It's always important to do. This next one shows senior level leadership. Again, that's relatively consistent with other areas of change. So clear leadership, particularly from the CFO, and where relevant, that could be backed up by the board, can help to ensure that new practices become part of business as usual. Specific one here about the investment committee and the opportunity to expand that. You should consider nominating a sustainability specialist to sit on the investment committee and to really make sure that sufficient consideration is given to the sustainability of the asset and the different features thereof. Collaborate internally. As I've already mentioned, don't do this in isolation. In particular, really making sure that you consult with your sustainability team or relevant sustainability specialist. It can really bring different skills and knowledge to allow you to make a more holistic decision in relation to that asset. Start early. Really make sure that you're not waiting for perfection. That you can start simple, you can learn as you go, and you can focus on what's most relevant to your investment without trying to cover every single aspect that could possibly relate to sustainability. Really also to ensure that sustainability specialists are involved from the start, like we said previously. Don't reinvent the wheel. All that's often needed to adapt existing investment appraisal processes is to include a broader set of considerations. It's not a complete overhaul. Share successes. So use success stories to engender support within your organisation, and to speak the right language. Talk about sustainability in business terms. Talk about cost savings and revenues and risks and return on investment, because that really highlights the financial and business impact in relation to the decisions that are being made. And finally, to collaborate across the value chain. So engage with your suppliers, talk to them, get their help for you to meet your targets. They already might have the data you seek, and they might be able to generate some more innovative ideas that could lower costs and improve sustainability. Next slide, please. So as I mentioned, the guide incorporates a number of practical examples on how different organisations have accounted for sustainability in their Capex appraisals. These are drawn from a variety of sectors and are as diverse as designing sustainable retail stores to building a carbon efficient water treatment plant. I encourage you to take a look and see what inspires you to do, to improve your Capex appraisal processes. Next slide, please. We've also developed a maturity map, which you can find on the Capex page of our website, to help you identify where your organisation is in terms of maturity in this space, where you might want to get to and how you might get there. It might be a little bit difficult to see on your screen depending on the size of your screen, but the maturity map has a beginner, an intermediate and a leader column. and it works across 4 different areas: the integration with Capex processes, governance and cross-functional involvement, appraisal scope and appraisal method. And it looks at the who, the what and the how to measure and how to decide in terms of the different decisions that you're making into relation to your Capex processes. So hopefully that should help you to understand the extent to which you have made a start on this journey and what might come next. Next slide, please. Finally, I've referred a couple of times to our Capex deep dive. So this was released early this year, and it's an extension to the initial Capex guide and considers 8 specific examples of how organisations are implementing the concepts contained in the original guide. It looks at the drivers for them for doing so, the methods they're using, as well as the challenges, the barriers, and the outcomes. Some of the key findings are highlighted here. So, for example, the key drivers identified relate primarily to financial factors, such as cost savings, and to regulatory influence and market pressures. Companies which feel the drivers most acutely tend to have more sophisticated, integrated methodologies. And the study found that organisations are increasingly including monetisation of non-financial capitals in their methodologies and using technology to support their analysis and decision making. Again, the Capex deep dive can be downloaded from our website alongside the original Capex Essential Guide. Next slide, please. So many thanks for your attention. I understand there'll be time for questions at the end, so I will hand back to Brigitte. Thank you.
Thank you very much, Helen. Now we'll have the case study presented by George Cope, Group Sustainability Accountant of SEC.
Hello, everyone, and thank you, Brigitte, for your time today. I'm going to take the detail that Helen's just discussed now and really just try and give you a flavour of how that has transpired and how we've developed that further in SSE. By way of background, the Group Sustainability Accountant sits within finance, but works very closely with our sustainability team. So I have a finance background. I trained as a chartered accountant with PricewaterhouseCoopers before moving into the sustainability role about 7 years ago. If we go to the next slide. So I thought it was going to be useful for me to take you through a couple of the key areas here. So I'll give a little bit of background on SSE so you can see how we have done it and what the challenges are for our company. What the triggers have been for us to incorporate ESG, so environment, social and governance factors in our Capex decisions. But probably what will be most useful for the listeners today is to share what we have learned. We've been doing this for nearly 7 years, probably spent in the region of about £2 to £2.5 million on this. And it really is, we've learned a lot, but as Helen says, we're very, very keen to share and collaborate because that's where some of our best of ideas have come. And what I want to also share is some of our continuing challenges so that we can have this further discussion and we can build on future case studies, work together collaboratively. Next slide, please. So SSE, we're a FTSE 100 company in the UK and Ireland. What you can see on the diagram on the screen is we have sort of 3 key business areas. So on the left-hand side, you can see where we have wholesale energy. So this is electrical generation, predominantly from renewable sources, onshore wind, offshore wind. We also do continue to have a portfolio of gas and gas storage, but we have recently just closed our last coal-fired power station, again, as we move forward to a 2050 vision. On the right-hand side, you can see that we also own a number of regulated businesses in the UK. This is predominantly a transmission network and 2 distribution networks. Again, this facilitates us a different type of business. We have the regulator as a key driver of our investment decisions, and very much working with the regulator to embed sustainability in these investment decisions for assets that can be created for anywhere between 25 and 70 years. We also have a third division, which is our retail business, which we are currently in the process of demerging. But again, it gives us that full interaction with customers, from exploration of gas in the North Sea right home to delivering that gas to people's houses. What I've done is we've recently just published our sustainability statement, where there's more detail around a lot of the sustainability criteria, how we're trying to incorporate the SDGs into our overall business strategy. So again, just a bit more detail for people there. Next slide. So I think it's really key, and one of the big decisions that has driven a lot of our initial work was getting ESG into our Capex decision. If you hit the next slide. And really, the way this has been framed at SSE is three really fundamental people in our company. So the person on the far left-hand side of the screen is Ian Marchant. So he was our CEO for about 10 years. He retired about 8 years ago. And it was just after I joined the company and became the sustainability accountant. And what was fundamental about Ian was that he had a vision. He understood what we needed to do as a company. He could see that the changing in the political views and what we needed to do as a large infrastructure company. We typically spend somewhere between 1.5 and 1.8 billion a year on Capex. He saw that we needed to do things differently. So as CEO, he initiated the first project that I worked on, and it was looking at a transmission line. It was a 250 million pound project that, through delays in stakeholder engagement, through delays and changes to design, the cost had escalated to approximately 600 million. And it was a case of this was the first major challenge to one of our engineering designs based on societal value, particularly around visual amenity. But there was also a big challenge around, you're spending 500-600 million pounds in the UK, but how much benefit, how much contribution to society does this project bring? Or are you spending UK bill payers' money on external companies? The next person there in the middle is Gregor Alexander, our current CFO and member of the A4S CFO network. Initially, after Ian gave us the license to operate the project, Gregor took over the governance and chair of the project. Gregor is, and Helen will vouch for this, very, very traditional CFO. He is very keen to be looking after the pennies, but also through the engagement on this project has now got this greater grasp of what we need to incorporate into our investment decisions. What are the key messages and facts and figures that we need to have at our fingertips to be able to develop a project to ensure that it is sustainable for not just one generation, but 2 or 3 generations. The final person on there is our newly CSO, so our Chief Sustainability Officer, Rachel McEwen. So Rachel, again, and I have worked very closely for the last 7 years, and it's been a fundamental journey. So where Helen was talking about language, Rachel headed up a lot of our corporate communications. So it would be a very interactive and wonderful partnership where myself and a couple of colleagues within the finance team would be developing the economic models, the narrative and the numbers, but it was really the language and our ability to communicate that has really taken us from quite naive analysis to really changing a fundamental strategy for a FTSE 100 company. So the lesson learned there is very much about having the correct tone, the correct governance, and the correct people to support a project. So key project sponsor. Next slide, please. So Helen introduced the guide. What is really useful is this quick 60-second read, and it's the introduction chapter that was written by our CFO. What is fundamental in this short paragraph, and if you're needing to put something in front of a CFO to get buy-in for this project, it's this. It really highlights two key things. One, that you don't need to fundamentally change your processes. What you need to be doing is you need to be mindful and wareful of what is coming and how you are going to address this. So it's small changes, or as Gregor says in the paragraph, it's about using your existing models which have brought you success, but tweaking them and incorporating different information in them. Next slide. So what have we learned in the last 7 years? So when I was appointed to being the sustainability accountant, I'd come from our internal audit function. I had a research background, but it was very much a case of we have a project. We have this large transmission project. It's over budget. We know that we have got a number of challenges involved in this. And if this is the first project where we are going to have these challenges, how do we develop a narrative? How do we develop our processes? How do we develop how we collect data so that in future projects, it doesn't get delayed, costs don't escalate? Because if you are going to develop sustainability practices, they need to be able to wash their face. They need to be able to cover the costs of what they're doing. As Helen says, you need to talk in terms of savings. You need to be able to talk in terms of benefits and what risk reduction this is going to have to a project. Is it going to help deliver it on time? Is it going to help deliver a project on budget? Is it going to be able to give you a better way to communicate with your stakeholders? Some of the other things we found, getting started was initially a difficult thing to do, but I really do believe now that you have the deep dive publication, you have the Capex guide, these really do distill down a lot of the key messages from finance people to succinct notes that you can use to develop and will allow you to get started. Once you've got started, get some friends. The key people that I work on a regular basis with are my finance colleagues, particularly around CapEx projects. So your finance managers, your cost accountants, your procurement and commercial people in terms of dealing with your supply chain and really starting to understand where you are spending money. Our HR team, we've done a number of projects around social impact, particularly around human capital. What is the value of our workforce? Where we have invested in training in terms of we have a limited amount of budget for training. Where are we going to get the greatest return? Where are our staff going to get the best benefits from investment in training? Environmental team, regulation team, particularly around what is changing, what do we need to be involved in now that will help ensure a project is successful in the future. The key thing about people is you want people with passion. This is going to be something that's difficult, and therefore you want people who are overly and above engaged in this process. Externals. Network is a key thing in terms of there are a number of companies out there who are going to be doing similar things. Identify them, identify critical friends, and as Helen said, in the guide, there's a number of examples there that you can use as well. Also, the use of external consultants, they're not all evil, and indeed, a lot of them have been working with us to help us develop the methodologies, to develop the thinking, to develop how we integrate this into projects. Next slide. So to share where we have developed, the link on the screen will take you to the reports that we have developed, but also quite fundamentally is the methodologies we've used. So we have a number of different economic models that we discuss, our human capital process, how we have looked at social impact, how we've looked at environmental impact. We typically, as I'm an accountant, tend to focus on the quantification of impacts. We tend to use pounds as our benchmark so that we can incorporate them into investment decisions. Again, this is debated a lot in the literature, but what we find is that because we publish our methodologies and we publish our processes of how companies can replicate what we have done, we find this is the best way. So a stakeholder can challenge us and they can use the process of our model to develop their own calculation to ensure that we are being open and transparent. Next slide, please. So going a bit more into the detail, our transmission business is currently going through its next price control, and what they've done is, as part of their journey, they've started to look at what is the key drivers and impacts, and what are stakeholders telling them that their investments need to be considering. So we've got three circles there. We've got the social, environmental, and economic, and the intersections are where an impact can have multiple different facets. What's important here is that when you're starting out and having a look at projects, that it's very easy to put something down on a long list, but it's not always that easy to quantify something. And also when you quantify things, you often find that adding an additional impact doesn't always bring you additional insight. So just because you can quantify doesn't necessarily need or mean you should quantify it. And this is where having a good governance structure and having a good ability to challenge the questions and the discussions that you have with your project team. So finance, again, has a very unique insight in terms of what data your company will have, what kind of costs, what kind of benchmark figures they can give you so that you can develop your different types of analysis. What we found when we did our initial project was that we quantified 12 different impacts for the Bewley-Denny line, which is a large infrastructure project. But 85% of the impact was actually driven by 5 different impacts, 1 economic, 3 environmental, and 1 social. And what we should have done was that we could have got the results out faster if we'd purely focused on those initially and then developed the thinking around that. If you go to the next slide. So what we've done is we've kind of started to use a standardized format. You'll see from our website that we've done maybe in the region of 15 to 20 projects, and each time we go through the same iteration process. So we do a lot of internal research with the different collaboration groups, but we also then do external research. So is this something that somebody else has already done and that we can also adapt or we can refine? And again, using external consultants will be able to give you that insight. We then create a long list of impacts. So something similar to the previous slide, what are all the different areas that stakeholders have even contacted you from, that you know is coming from a policy, or that you are receiving a challenge, or indeed, what do you want to develop as a company? Do you want to be the most environmentally friendly, the most socially responsible company? This is when you would start to build these into what you want to get and gain from a CapEx project. Number 3 there, very much about quantitative versus qualitative. Some measures are going to be good enough to just be developed through a narrative. Other impacts are fundamentally, in my belief, that are numbered and quantified, particularly around when you're looking at major design changes. Is a stakeholder ultimately going to invest in your company if they have developed projects that are uneconomical? You need to be able to develop a boundary on which further investment is not going to be economic, and it's not going to, again, be bringing you additional benefit. Once you've then developed the methodologies, it's fundamental that you then talk to individuals and that you have these to develop the projects. Number 5 is documentation. This is one of the absolutely fundamental messages we have found, and it really do need to pass on. Once it's written down, it can be critiqued. You can put it in front of a CFO, you can put it in front of a director, non-execs, you can put it in front of regulators. It just allows you to have a very clear definition of what you are doing and what you are not doing. And then number 6, do the analysis, carry out the project, capture the results, and then challenge yourselves, and then go back to number 1, and it's an iterative process. Next slide, please. So in summary, I think probably the key lessons are, if you're doing a project, start small. We tend to do a number of small projects in 1 year rather than doing just one project over 3 years. Just with the type of business we are, things change. You know, policies can change, price controls can change, external pressures can change, and therefore, if you have a project in development for too long, then it could actually not be of benefit to you overall. So short company-wide projects, or very, very bespoke projects, which have the ability to be replicated or expanded, but develop the results, get emphasis on what the benefits are, and that will really breed a momentum into the projects and future projects. But most fundamentally, don't give up. It's a difficult journey, sustainability accounting, but it's wholeheartedly worth it. And it just, you know, you've taken the first difficult step, getting started, finding the A4S guide, coming on this webinar. The rest of it is just a fun roller coaster. Thank you.
Thank you very much, George. So we'll start our Q&A session. So if you want to ask if the participant want to ask question, either you can type in the chat box your question, or you can just unmute yourself and ask directly your question to our speakers.
Hello, this is Bob Lux.
Hi, Bob.
Hi. Great presentation. Thank you so much. George, I have a question for you. You talked about human capital quantification. Can you give some more examples or specifics of what you do or try to do and quantifying that and how you think through that?
Yeah, no problem. So we've got publications on our website, so you can read them all in detail. The big thing we had was it came as a challenge from our CEO, who has a very big focus on the people. So SSE is not the biggest company in the world. We're 21,000 people, but people, you know, fix our power stations, people put up transmission lines, people keep the lights on. And so he wanted to ensure that he was looking after his people. We use a method where it's done on economic income, so what we ultimately pay our staff. We then model that over the lifetime, which we believe that somebody will work with us. So again, we've got very good track records of people staying with us for 30, 40 years. And what we then do is we use the sort of annual salary as an indicator of the economic growth. What we also then do is take into consideration our number of other factors when people retire, how much a particular job will grow. So we distilled our jobs into job profiles. So we had 16 job profiles for the company. So you could be an accountant, you could be an engineer, you could be a director, you could be a member in the call center, and that would allow us then to extrapolate where we thought their income and their promotions would go. So again, that was a quick overview of that. The methodology is, as I say, on the website. What was really useful though was that gave you an overall stock value, but the year-on-year flow, and so how things change and where an intervention can be valued was also a real insight. So we have a scheme where we will employ people who have been out of work for 6 months, and there was a challenge to say, well, is anybody actually benefiting from this scheme? And the analysis we did showed that it actually generated a very, very high return on investment, not only for the company, which covered its cost, and you know, these people made a positive contribution to our company, but it made a massive contribution to the individual in terms of well-being and their contribution to society. So previously, because they were receiving benefits, they were a negative to society, and then they were now paying taxes back into society. So that was seen as a net gain. So it's really interesting, and there's loads of areas I'd like to go further with it.
Thank you, George. I actually have a question for Elaine. You mentioned earlier deep dive work. I would be interested in hearing more about the drivers you identified. What were the most important factors that led them to account for stability within their Capex process?
Okay. The key drivers, they fell in a number of areas. We looked at external drivers and obviously also internal drivers. The external ones were predominantly either financial or through regulatory influence or through market pressures. So those financial ones, there was a number in there that related to cost savings, and the link back to downward price pressure and competitive cost advantage was in there. There were financial factors in relation to increasing the asset market value. So either through any rent that asset could bring in, or on sale of the asset. And then the third financial factor was in relation to access to finance. So this, I guess, is essentially where having sustainability factors embedded into the asset allowed the organisation to have access to finance that they wouldn't otherwise have access to. So the examples that were identified was a green bond, and also a UK government mechanism that we have here, which was a regional growth fund. And so those factors actually allowed allowed the organisation to get additional funding. On the regulatory influence side, there was areas here around response to regulatory pressures on service, on resilience, on affordability, which is possibly something that George can relate to, and also on planning. So finding that by having sustainability factors embedded, it was much easier and much smoother to be able to get the planning authority that they needed in order to build the asset. And the final one on the external side was in relation to market pressures. So pressures from customers in relation to reputation and also peer pressure. So where competitors and other organisations were already doing this, and organisations sort of feeling the pressure to respond. So those are on the external side. The internal ones were all around leadership, personal passion and motivation of the individuals who were carrying out and developing these methodologies, carrying out this analysis. And the third one was around company values, with the finding really being that when those three things come together, then they're really powerful drivers. But all of those three are essentially also responding to those external drivers.
Thank you, Elaine. I would have another question, but it's for George this time. If you had your 7 years again, what would you do differently?
Oh, time. I think the biggest thing there would be consult people earlier. We spent the first probably 12 to 15 months working on this project on our own. And although we had external governance board, which was broad, I think it would have really benefited from insight from other companies who were working in this space earlier.
Hello?
Oh,
George?
Yeah.
Sorry.
Yeah, no, just sorry, was I on mute there? Sorry.
No, you were not. Sorry. I saw that you were saying something else after that. Sorry.
No.
Okay. A difficult question. Is it not just greenwashing? At the end of the day, you're an utility company. That will be for George.
It could be seen as greenwashing. And again, what we are seeing is that a number of the narratives that we publicize and we talk about has that perception. And I think it's because it's quite a wholesome change in our business. But I think what's very unique about SSE is that we have made key fundamental decisions, and we have provided evidence to our regulators around how sustainability, particularly either environmental or social consideration, has changed our decisions. One of the projects we're working on just now is our subsea cables, where we are looking at changing fundamental engineering decisions based on the level of burial and protection we put around a subsea cable, based on what is the natural capital of that environment, what is the risk to society, to other marine users in that particular area. So we are fundamentally changing our difference and our projects and how we invest. So I think that's why this isn't greenwashing. This isn't just coming up with statistics that don't go anywhere or haven't come from anywhere. When Helen was talking about the different stages, we have started a number of projects when a design has already been done, but that's because we needed the data. And we're slowly moving back to earlier points in the decision where we can make fundamental changes to investment decisions, where we can embed what the calculation for carbon is and to articulate, is that the best thing for the future generations? So no, I think in the past it might have been, but I think not where we are now. and not where we're going to be going in the future.
Thank you. I will give a last opportunity for our participant to ask a question to our speaker directly. If you unmute your call. Otherwise, I will finish with the last question, which will be for Hélène. What kind of methodology are you seeing used in practice?
I think so the best way for me to answer this is just to reflect back on the Capex deep dive and some of the methodologies that came up as part of that. I guess just to give a bit of context to that, there were 8 companies that were looked at, and they were across 4 sectors. So property and construction, power and utilities, water, and retail and consumer. And out of those 8, the methodologies being used by 4 of them were based on net present value. And so going back to the comments that we made earlier about using what you've got and just adding to it, it is obviously a well-recognized financial methodology. Just tweaking it and adding things to it is all that's needed. Similarly, 2 used IRR, so internal rate of return, and 1 used payback methodology. And 1 used essentially what was a combination between net present value and payback. But they did all obviously move away from the basic use of those methodologies, and there were varying degrees of sophistication. At the very high end of that scale, 1 company developed an NPV appraisal of their whole of life cost benefit analysis, their whole of life cost benefit across financial, natural, and social capital. I think it also incorporated human and manufactured capitals as well, and there was some monetization embedded in that technique. So there was a lot of variety. Some also incorporated sort of multi-capital decision analysis, but mostly just in a sort of a relatively simplistic form. So hopefully that gives a feel of the kind of things that were in there.
Thank you very much. So with this answer, I would like to thank our great speakers, Hélène Slinger, Executive Director at A4S, and George Cobb, Group Sustainability Accountant at SEC, for sharing the insight and experience on this topic. If you missed the 2 previous A4S IIRC webinar on enhancing investor engagement on strategy, planning, budgeting, and forecasting, the recording are available on the website of A4S and of the IIRC. We are planning to have 3 more A4S IIRC webinars in 2019 on Tuesday, 24th of September, on Tuesday, 8th October, and Thursday, 7th of November, to give you a flavor of the material developed by the A4S CFO Leadership Network with tips and practical studies. These guides support the adoption of integrated thinking and management, and you should consult them on the A4S website. With this, I wish you a good evening or afternoon wherever you're located. Thank you.